Welcome, everybody. Today we have the pleasure to listen to two very interesting lectures by two distinguished scholars who this year received Yrjö Jahnsson Award, Ricardo Reis and Silvana Tenreyro. Before we begin, let me say a few words about Yrjö Jahnsson Foundation. Yrjö Jahnsson Foundation is a private trust founded in 1945 to promote research in economics and medical sciences. Today, the assets of the foundations amount to around 90 million euros. We distribute annually about 2 million as grants to research grants to economics and medical sciences. Over the years, Yrjö Jahnsson Foundation has made a number of initiatives. It started Yrjö Jahnsson lectures back in 1963. It introduced health economics into Finland in the 70s. It started graduate training courses in late 1970s. And it introduced, together with European Economic Association, Yrjö Jahnsson Award in Economics in 1993. Yrjö Jahnsson Award in Economics is distributed every second year. This is the 14th time this award is delivered. It is, according to the rules, it is awarded to an European economist no older than 45 years old, somebody who has made a contribution in theoretical or applied research that is significant to economics in Europe. This is a joint venture with European Economic Association. The winner of the Yrjö Jahnsson Award in economics receives 20,000 euros, or 10,000 if shared between the two award winners. We have the selection committee, which is selected by the board of European Economic Association and the Yrjö Jahnsson Foundation. Here's a list of the names of previous award winners. And this next time the award will be delivered 2 years from now. Selection committee this year was composed, it was chaired by Horacio Atanasio, and it had is composed by 5 other scholars, European scholars, among which Philip Akhion, who was award winner in 2001, and Oriana Bandiera, who was award winner 2 years ago. Now I give the floor to Terhi Masulski, Research Director of the Yrjö Jahnsson Foundation. She will introduce the lecturers of today and will moderate the later discussion, questions and answer sessions. Terhi, the floor is yours.
Thank you, Antti, for your introduction. Yes, it's definitely our pleasure to have you here. So the Yrjö Jahnsson Award winners 2021 are Professor Silvana Tenreyro and Professor Ricardo Reis, both from London School of Economics. And the motivation made by the selecting committee is that they have both made very important contributions to macroeconomics. A few words about Professor Silvana Tenreyro. Well, she has made important contributions to monetary economics, macro development, and in international economics. In monetary economics, for example, she devised that new strategies to identify the role of nominal wage rigidity in monetary policy's impact on economic activity. In macro development, on the other hand, she found that both technological change and international trade can help countries diversify macroeconomic shocks. In international economics, she has made an important contribution to estimating gravity equations. Professor Ricardo Reis, he was an early innovator in terms of introducing sticky information into macroeconomic modeling. He has also examined the impact of taxes and transfers as a source of automatic stabilizer in economies characterized by financial market incompetence and frictions in price setting. There has also been other contributions to financial frictions and central bank design and policies. So congratulations to Silvana Tenreyro and Ricardo Reis again about this award, and we are very honored to have you here in this webinar. And here I'm gonna give some few information about this program. So soon we will have Professor Silvana Tenreyro, and she will talk about nominal currency and the impact of monetary policy. After that, we will have like 10 to 15 minutes questions and answers section. And you can send questions to this section via a chat function. And then we will have short 10 minutes break during which you can go and get some cup of coffee or so. And then we will start the second section of this program, in which Professor Ricardo Reis will tell something about expectations, inflation, and the public debt. And then there will again be like 10 to 15 minutes questions and answers section. And then the webinar ends. But now I will give the room to Professor Silvana Tenreyro.
Thank you very much. And thank you very much for the award. It's an honor to receive this prize, and I'm very grateful to the Yrjö Jahnsson Foundation for its generosity and its support of academic research across all fields over all these years. Thank you also for the invitation to speak today. My talk will be based on my work with Michael McLeay on dominant currency and the impact of monetary policy. So the question we are addressing is, can monetary policy help to stabilize the economy when vehicle currencies are used in international trade? The question of stabilization is a perennial one in macroeconomics, but we want to answer it from the perspective of countries, often developing and emerging economies, that export commodities or goods and services that are traded in fairly competitive export markets. And concretely, we focus on economies that use the US dollar as a main invoice currency. The goal is to understand how dollar dominance affects the transmission of monetary policy. This is an urgent question as we exit from the pandemic. Most emerging and developing countries have used their fiscal tools to combat the pandemic. Many of them will be highly constrained in their fiscal capacity in coming years. And hence the question is whether monetary policy can help as a stabilization tool in the post-pandemic world. While, as I said, our main motivation comes from developing and emerging economies, many of the arguments and implications I will discuss today also apply to advanced open economies. So my plan is to start setting out the background, then I will present the model and the simulations, and next I will turn to the empirical evidence before concluding. So let me start with the background. Why are we asking this question? As highlighted in the work of Linda Goldberg and Cedric Thiel and Geeta Gopinath, the US dollar is the main currency of invoice in international trade transactions. Even though international trade with the United States is only a little over 10% of global trade, nearly 50% of international trade is invoiced in US dollars. And this is illustrated in this chart. The light blue bar here shows a country's exports to the United States as a share of its total exports. The dark blue bar shows the value of exports invoiced in US dollars as a share of the country's total exports. So the shares here corresponds to averages over 1999 to 2014. So for the United Kingdom, for example, the share of exports to the United States, as you can see at the very end of the axis, was 17% over this period, while the share of UK exports invoiced in US dollars is was nearly 30%. For countries like Argentina or Brazil, the share of exports invoiced in dollars is nearly 100%, even though their export shares to the US are well below 20%. The dollar dominance has led to a new paradigm that is shifting policy views. The inference that has been drawn is that an exchange rate depreciation by a country invoicing in dollars does not provide a boost to exports. In other words, there's no expenditure switching to that country's exports when the currency depreciates. This, the argument goes, means that flexible exchange rates have a more limited role as automatic stabilizers, and hence that the exchange rate challenge of monetary policy transmission is weak or weaker. The implication for policy suggested by the IMF and the BIS is that other stabilization tools, for example, capital controls, may need to be deployed because exchange rate adjustments are not effective as automatic stabilizers. This statement is taken from the IMF 2019 report. The IMF says exchange rate flexibility may need to be supported by other policies. Exchange rate changes have muted effects on the trade balance in the short term, including because of the limited response of export volumes. So the policy view shaping up is that exchange rate fluctuations have little or no impact on the trade balance, owing to the limited effect on export volumes. Now, why is this? There are two key assumptions underlying the thinking. The first is that exporters have monopoly power, and the second is that prices are sticky. And in the dominant currency framework, they are sticky in US dollars. If exports are sticky in dollars, an exchange rate depreciation by any country other than the United States does not change the export price in dollars. And if export prices don't change, there's no expenditure switching towards that country's products and no increase in demand or quantities demanded. Now, I like to answer and argue that these assumptions are much less likely to hold outside of the US. Many developing and emerging country producers tend to be price takers. They export commodities or commodity-like products with little, if any, market power. And while the prices of those products are often quoted in dollars, those prices tend to be fully flexible. I should add that even in advanced economies like the UK, producers often face very elastic demands in global markets with quite flexible prices. And there are many other advanced economies, including Australia, Canada, and New Zealand, that also share these characteristics. So let's go through these points in more detail. This graph illustrates the logic underlying the dominant currency paradigm. This is an exporter with monopoly power facing a downward sloping demand curve. The monopoly sets the price so as to maximize profits, and that price is sticky in dollars. A depreciation of the currency lowers the cost of production expressed in dollar terms. Think about labor costs, real estate, or other non-tradable inputs entering the cost base of the producer. These costs tend to be set in pesos or domestic currency, so a depreciation shifts the cost curve downwards when expressed in US dollars. The profitability of the exporter increases in this case, but her price does not change because it's assumed to be sticky, hence the quantity demanded doesn't change. And as a consequence, the depreciation does not boost the monopoly's exports. The quantity exported doesn't change. What this standard new Keynesian model misses is that a large share of emerging and developing countries are commodity exporters. And these, incidentally, are the typical clients of the IMF. Commodity producers face elastic demands as illustrated in this extreme graph here, their prices are fully flexible, yet they also do not move with the depreciation of their domestic currency. Why? Because the producer is a price taker and prices are determined in global markets. However, export quantities increase with the depreciation. As before, a depreciation of the currency reduces the input costs expressed in dollars, so we have the same shift in the cost curve. And the only constraint really for this producer is capacity, not demand. Now, the literature has interpreted this lack of pass-through from a depreciation to export prices as evidence of sticky prices in dollars. But as illustrated in this graph, and this is perhaps one of the main contributions of this paper, there's also zero pass-through to export prices if the producer operates in very competitive markets and her prices are fully flexible, as in this example. Lack of pass-through is not evidence in favor of sticky prices or in favor of dominant currency or the dominant currency model. The dollar prices of commodities do not change with the depreciation, but that is not because of sticky price frictions. On the contrary, limited pass-through comes from a highly competitive global market with full price flexibility. But the exception here doesn't stop at strict commodities. Many producers in developing, emerging, and indeed advanced economies outside the US are closer to commodity exporters in that they face quite elastic demands and their prices tend to be flexible. This is illustrated in this chart with very elastic demand curves. The pass-through to export prices might be very small. We see very small changes in prices here, but that doesn't mean that quantities do not move. On the contrary, with very elastic demands, quantities might move a lot, as illustrated in this graph. Again, depreciation lowers the cost of production expressed in dollars. Export prices change little because demands are highly elastic, but exported quantities increase a lot. How much they increase is largely determined by capacity, captured here in a stylized way by the upward sloping supply curve or cost curve. So just to recap, with monopolists and sticky dollar prices, a depreciation by a non-US country does not affect export prices or export quantities. Monetary policy and exchange rate movements have no effect on exports or quantities more generally. However, with commodity or commodity-like producers and flexible prices, an exchange rate depreciation also doesn't have an effect on export prices or much of an effect, but it increases export quantities. How much quantities increase ultimately depends on the supply capacity of the economy. So let me make a few remarks on the literature. The dominant currency literature has pushed the frontier in the field, making it consider more seriously the implications of dollar invoicing or vehicle currency more generally. Parenthetically, as it turns out, a few other currencies are also important in international trade transactions, as documented separately by Denis Novi and co-authors and Giancarlo Crosetti and co-authors, and in the context of international financial transactions, also Ricardo Reis has done work on this. But invoicing in US dollars does not imply that prices are sticky, nor that does imply that there is monopoly power in pricing. And indeed, as conjectured by McKinnon back in 1979 and suggested by the evidence in Goldberg and Till, it is reasonable that the more competitive the market, the more likely a producer would invoice in a dominant currency. Commodities are, of course, a quintessential example from the perspective of many countries that are price takers. But as I said earlier, there are also other goods and services that are not exactly commodities, in which producers are essentially price takers. So what seems like a minor and indeed a common assumption in this literature has huge implications for monetary policy effectiveness and for the role of exchange rates as automatic stabilizers. So put differently, the assumption is immensely consequential for the advice the IMF might give to its client economies. So let me now turn to item 2 in my plan and introduce the model economy, which we will use to answer the question quantitatively. I will then present the key simulation results from the model and discuss the empirical evidence. So turning to the model, we stick very closely to the dominant currency model of Gopinath and co-authors at the AER. And we try to deviate minimally from it in order to stress our key point. And indeed, we show that that minimal deviation can have large effects from a positive perspective and also for the policy implications. The setting is a standard New Keynesian model. We focus on the small open economy version of it, but the arguments extend to the 3-country version with larger countries. Financial markets are incomplete. There's no international risk sharing, but there's perfect risk sharing within a country. In terms of production and competition, we assume imported intermediate inputs enter the production process. This in principle should limit the effect of exchange rate depreciations on exports or more generally on activity, as the depreciation increases the cost of intermediate inputs. But as we will see, this does not offset the main intuition I described earlier, as labor inputs are also quantitatively important in the cost base of most exporters. So we assume that consumption and intermediate inputs have a nested CES structure, as in the work of Finstra, Lack, Obstfeld, and Russ, which allows for a distinction between the elasticity of substitution between different goods and the elasticity of substitution across different varieties of the same goods produced at home or abroad. And you can also interpret those goods categories as sectors or industries. Now, the work of Gopinath and co-authors in the ER and their parametrization implies low elasticities of substitution, irrespective of whether that is across goods or across varieties within a good category. And irrespective of whether they are produced domestically or abroad. So, for example, the crude oil produced in Mexico is different from the crude oil produced in Argentina, and the elasticity of substitution between them in steady state is assumed to be 2, the same as the elasticity of substitution assumed for oil vis-a-vis apples or educational services. So they all have the same elasticity of substitution. Now, this is very different from other models of international trade. For example, in Eaton Cortum, for those who are familiar with their work, a given variety, say crude oil, in Mexico can be produced domestically or abroad at different costs, of course, but essentially the crude oil in Mexico is the same as in Argentina, the US, or Saudi. So the elasticity of substitution in that Eaton Cortum model or Alvarez and Lucas is infinite, which leads to perfect competition for that variety. Now, we take a middle-of-the-road approach between Eaton Cortum and the work of Gopinath and co-author and assume that the elasticity of substitution across goods is 2, as in Gopinath and co-authors, but the elasticity of substitution across varieties of a given good is higher and in line with the estimates in Broda and Weinstein for more homogeneous products. So producers still have some market power. Competition is not perfect, but they face much flatter demand curves for a given variety. Consistent with that, we keep the monopolistic competition assumption as in the literature, but with more elastic demand curves and flexible prices. On wage setting, we follow the dominant currency paradigm and in general the new Keynesian framework and assume wages are sticky in domestic currency and their adjustment follows a Calvo process. This captures a relatively higher importance of trade unions and collective bargaining in some of these economies. Different from the dominant currency model, we, as I said, allow for flexible prices. They can be invoiced in dollars in line with high levels of competition in global markets and their demands being very flat. And this, incidentally, is one of the key insights from state-dependent models. When demands are elastic, the cost of not adjusting prices is very large because a small change in prices can lead to big increases in profits. So the flatter the demand, the more flexible prices will be. In other words, in more competitive markets, the assumption of sticky prices is much less appealing or realistic. Prices are quoted and invoiced in dollars, but there are no frictions making them sticky. We compare this to the assumption of sticky prices in the dominant currency literature, and that's what I will be showing you in terms of simulations. As I said, we consider a small open economy denoted by H, and we take the rest of the world as exogenous, the whole dynamics of the rest of the world as exogenous. So implicitly, this subsumes both the US itself, but also other third countries where exports may also be invoiced in dollars. We defined as epsilon dollar the price of a dollar expressed in pesos or the home currency. So an increase in epsilon here or more pesos to buy a dollar will represent a depreciation of the home currency. Households maximize their expected lifetime utility over consumption and labor choices. As I said, consumption has a nested structure, a CES nested structure. This allows for a distinction between the elasticity of substitution across different goods and the elasticity of substitution across varieties of the same good produced at home or abroad. Goods, as I said, can also be interpreted as industries or sectors. This reverses the nested CES structure often used in the open economy macro literature, which allows substitution between baskets of goods produced in different countries, but does not permit competition at a lower level of aggregation. So here a household in country H consumes a bundle of goods given by an aggregate of goods G here with sigma, the parameter sigma representing the elasticity of substitution across different goods or industries. Within each category G, consumption consists of different varieties produced either at home or abroad in all other countries J. Each country produces a set of varieties of each good of measure omega. So this is for country J and good G, all of which are sold both domestically and as exports in each other country. Consumption of good G in the home country H is hence given by this expression, where this object here denotes consumption by home households of variety omega of good G produced and exported by country J. So when J equals to H, or the home country, this consists of domestically produced varieties. The elasticity of substitution between foreign and domestic varieties, as well as between different varieties within a country, is given by eta G here, which, as I said, can be different from sigma. When eta G is equal to sigma for all goods G, then consumption demand reduces to the CES version of the model in Gopinath and co-authors. In that model, there's no distinction between different varieties of the same good on the one hand and different goods or industries on the other. So as I said, in our slightly more general setup, these two objects can differ. The budget constraint here is standard. We have perfect resharing within a country, but no resharing across countries. The uncovered interest rate parity condition holds in the model. The production process combines workers and a composite of intermediate inputs, X, and we assume that intermediate input varieties are aggregated in the same way as consumption varieties, which leads to this simplified expression here for total spending. Labor is an aggregation of the workers from the different unions, and the demand for workers has a standard CES formulation. Now, in the simulations I will show you, we compare flexible prices with sticky prices a la Calvo. Exports and import prices are either set in dollars or in the producer's currencies, as in the Mandel-Fleming canonical model. For firms that cannot adjust prices in dollars, a depreciation of the peso increases their profits as domestic costs do not increase by an equal amount, given that workers are still paid in pesos, but export prices and export quantities do not adjust, as in the first graph that I showed you. Only prices of those touched by the Calvo ferry will adjust, so that leads to a very small adjustment in quantities in that case. With flexible prices in competitive markets, export prices fall with a depreciation, but if the demand elasticity is very, very high, they will fall by a little. And regardless of whether the prices change, export quantities will increase. The higher the elasticity of demand, the more they increase. In the case of flexible prices, the optimal dollar price is given by a markup of over marginal costs. So we close the model with a simple inflation targeting rule. And in what follows, we will analyze how a monetary policy impulse, mu here, transmits to the real economy. Because we have an uncovered interest rate parity condition in the model, the monetary policy expansion will cause a depreciation of the currency. So let me now turn to the simulations. To compare to the benchmark, we calibrate the model closely following Gopinath and co-authors, except where highlighted in red. For the elasticity of substitution across goods or sectors, we use a moderate value of 2. And we compare to a benchmark sticky dollar price model, which uses a value of 2 also for the elasticity of substitution across varieties, consistent with the idea that firms are monopolists for their own variety. But in our flexible price model, different varieties within a good category will have higher elasticities of substitution. In fact, we will use 17 as per Brodan and Weinstein's results. We consider both the case of no price rigidity and price rigidity with delta equal to 0.75. And we adopt a Taylor rule with limited smoothing that responds quite aggressively to inflation. The impulse responses here show that the intuition from the earlier graphs that I showed you follow through to the full general equilibrium model. The simulations show the effect of a monetary policy expansion, a cut in the interest rates, comparing the sticky dollar price monopolist, here in blue, to our flexible price homogeneous goods producer in red. As an additional comparison, the black dashed lines here show a variant where goods are sticky in the producer currency as in Mandel-Fleming. In all cases, the policy shocks the policy shock leads to a sharp depreciation of the domestic currency relative to the dollar, shown here as a rise in the exchange rate. Import prices in dollar do not change, but import prices in pesos, or the domestic currency, increase, and that leads to higher inflationary pressures in the economy. Our focus here is on export, and in both the the dominant currency model in blue and in our model in red, export prices in dollars move only a small amount. This contrasts with the standard Mandel-Fleming assumption of sticky producer prices in the dashed lines, where the depreciation mechanically lowers prices when expressed in the foreign currency, in this case, dollars. As in the stylized charts I showed you earlier, the reason for limited pass-through differs across these two models. In the dominant currency framework, prices are sticky in dollars by assumption, and with low elasticity, the result is that export volumes are little change. So there's no change in export quantities, or virtually no change there. In contrast, in our flexible price model here in red, with more homogeneous goods, the elasticity is higher, so even a small fall in dollar prices leads to a large increase in exports and hence in output, as illustrated in the two activity charts, exports and output. This slide here summarizes those responses quantitatively, showing the average effects for the first year following the monetary policy intervention. Now, despite similar depreciations in the three models, as shown in the first row, and despite limited pass-through coefficients from depreciation to export prices in the dominant currency paradigm and in our model, as shown in the fourth row, in our case, export volumes rise over 10 times as much as in the dominant currency benchmark. Let me skip this. So in reality, of course, some exporters adjust prices more frequently than others. Some face more or less elastic demands. So the key empirical question is which conditions are faced by dollar pricing exporters. Intuitively, the cost of not changing dollar prices, as I said earlier, even by a little bit, are likely to be much higher if the elasticity of demand is high. So let me turn to the empirical evidence now. This table compares the two models in terms of assumptions and predictions. In terms of assumptions, the dominant currency literature assumes exporters have high market power and face fairly inelastic demands. Our model instead allows for a high degree of competition across countries via a high elasticity of demand for individual varieties. Second, in terms of assumptions, the dominant currency literature assumes sticky prices, whereas we assume prices are adjusted flexibly. In terms of predictions, both models predict that pass-through from exchange rates to export prices in dollars is low. So there's no distinction between the two models here. But the dominant currency model predicts little export quantity response in the fourth row, whereas our model predicts exports and outputs respond strongly. I will now go through these assumptions and implications in turn and argue that our model is more suitable to represent developing and emerging economies. The first fact I would like to highlight is that a large fraction of developing and emerging countries' exports are homogeneous goods, as illustrated in this chart here. More than 60% of exports of developing countries and 50% of emerging markets are strictly homogeneous goods using Rausch definition of goods sold in organized markets or having a reference price. And this is much higher for some economies like Ghana or Chile, whose shares here are in the order of 80%. The second fact to highlight is that homogeneous goods prices are highly flexible. Here as an example, I just plotted raw movements of various commodity prices. They're anything but sticky, as we know very well with what's going on with commodity prices these days. This is confirmed by many papers that examine price stickiness by product category, including the work of Emi Nakamura and John Steinsons, whose results I show here, which showed short durations for goods such as unprocessed food and also in the paper, crude materials. In earlier work, Gopinath and Rigobon also for the US, as Nakamura and Steinson, these results are also for the US, as you have said. So Gopinath and Rigobon, aggregating across homogeneous goods, find that they are adjusted far more frequently than differentiated ones, and there's a big difference between those. These patterns also hold in developing and emerging economies. Multiple studies for Argentina, Brazil, and several other countries confirm that more homogeneous sectors display high frequency of price adjustment. And overall, in those countries, the frequency of price adjustments is much higher than in advanced economies. So these two facts, the fact that homogeneous goods imply high competition and flexibility, they clash with the two critical assumptions of monopoly power and price stickiness. So now let me turn to the two implications that I discussed. And let's start from the premise that exchange rate changes have small effects on export prices in US dollars. The dominant currency literature interpreted this as evidence of price stickiness, but as I hope I made clear, for exporters of highly competitive products facing highly elastic demands, an exchange rate depreciation does not change export prices either. This lack of pass-through does not imply price stickiness. On the contrary, those prices are perfectly flexible. The lack of pass-through into prices cannot distinguish between the two models. Hence, the test in terms of prices cannot work. It's not helpful. The ideal test to the model implications lies on the behavior of quantities. The key challenge, as usual, is identification. Depreciations do not happen randomly. An ideal test, mimicking our theoretical analysis, would analyze the effect of monetary policy shocks, which move exchange rates but should be orthogonal to other determinants of export volumes by construction. Domestic monetary policy shocks can be thought of as an external instrument for the exchange rate. Now, a few people have looked at the effect of monetary policy shocks in the context of advanced open economies. However, there's not much, perhaps unsurprisingly, for developing economies, possibly because it's harder to identify those exogenous monetary policy shocks to use as instruments, given that there has been more variability in their monetary policy institutions and regimes. The challenge is an econometric one. Now, to the extent that we can learn from other small open economies that are more advanced but have better identified monetary policy shocks, there are two studies that directly look at the response of exports to monetary policy shocks. One is the one I'm showing here by Champagne and Seckel in the JME, who estimate the effect of a contractionary monetary policy shock in Canada, constructed using the narrative approach of Romer and Romer. Here, a 100 basis point policy contraction causes an initial appreciation of the Canadian currency, and this causes a significant fall in exports quite quickly, actually. Imports do not react much initially, but eventually they also fall with the overall fall in GDP. The responsiveness of export here is consistent with our model, as Canadian producers operate in quite competitive product markets abroad. The second study I wanted to highlight is by Cesabianchi, Thwaites, and Bioconda for the UK, who use high-frequency identification to isolate monetary policy shocks. Again, they find a significant appreciation of sterling in response to a monetary policy tightening, and this is followed by a sharp and significant fall in exports as well as imports. And again, this is consistent with our approach and our model. Export quantities respond by a lot, even in settings with a high prevalence of vehicle currencies like the UK. Now, as I said, there is surprisingly little for developing and developed economies, in part, as I said, because it's harder to identify monetary policy shocks. Some countries do not have an inflation targeting framework, or at least not for a sufficiently long period of time. However, this chart for Latin American countries is taken from a study by Pérez Forero of Latin American countries. He identifies domestic monetary policy shocks with signed restrictions, with a tightening assumed to cause an exchange rate appreciation on impact. And Pérez Forero finds a strong response of output falling significantly in all Latin American countries with the monetary policy tightening and the consequent appreciation of their exchange rates. Unfortunately, he doesn't have exports, so we had to do the work ourselves. And to do that ideal test, we used data from Brandao Marquez and his co-authors at the IMF, and follow their identification approach using their very rich database. Monetary policy shocks here are identified as a residual to a policy rule that reacts to forecast inflation, forecast output, past inflation, and output, as well as exchange rates. Naturally, this will be more fitting for countries with a good monetary policy framework than for others. So I will show you later on some results distinguishing between those two groups. We use local projection models to estimate the effect on macro variables, including industrial production, inflation, and exports. As Brandao Marquez, I will show you impulse responses to a monetary policy shock, which causes a one standard deviation increase in rates, in policy rates, that is, and an appreciation in the exchange rate. And I will interact the response with some countries' characteristics to distinguish between those with a clearer monetary policy framework and hence sharper identification. So let me show you what we get. A monetary policy tightening shock in these developing and emerging economies causes an appreciation of their exchange rate, as shown in the left-hand chart, and a fall in exports, as shown in the right-hand side chart. The point estimates for exports are very large and significant at the 68% level and just about significant at the 90% confidence level. Both CPI inflation and industrial production fall significantly, as illustrated here. On the right, you can see industrial production, which is the only broader measure of activity that we have from the Brandao Marquez database. Now, as I said, this is a highly heterogeneous sample of developing and emerging economies. And of course, not all of these countries adhere to the framework we model in this paper. So This is why we split the sample into two groups, countries with high levels of central bank independence on the left, and countries with low levels of central bank independence on the right. With high central bank independence, here in green, there is a clearer monetary policy framework, and we are more confident about the identification of a monetary policy shock. And indeed, in countries with high levels of central bank independence, we get results that are even more in line with what the model would predict and in line with the results for advanced economies, a very highly significant and large response of export to the monetary policy tightening and the consequent appreciation. Similarly, we get a larger and bigger response for industrial production, again here on the left, and whereas we don't find significant differences between the two groups in terms of CPI inflation. In both cases, it's fall. It's more immediate, the fall, at least in terms of point estimates, in the case with central bank independence or high central bank independence. So now moving on to the conclusions from this set of exercises. The dominant currency paradigm has advanced the frontier on many directions, but the standard framework has adhered to two features that are not realistic for most developing and emerging economies, and indeed not even for most advanced economies, barring the US, of course. Those two features, as I said, are monopoly power and sticky prices in export markets. Though this might seem an innocuous assumption or standard, it has huge consequences for policy, so it's critical that those assumptions are properly scrutinized. The empirical evidence suggests a large share of exports in developing and emerging economies are of homogeneous goods, and as such, they are more likely to be, the producers are more likely to be price taker in global markets. While their prices might be invoiced and quoted in dollars, they are more likely to be flexible. The limit example that I show you in my picture was a commodity producer, but as I said, it works, the same intuition goes through for monopolistic competition with highly elastic demands. Both in the dominant currency paradigm and in the modified model I presented, pass-through of exchange rates to export prices is very limited, but the two models have hugely different implications for export quantities and more generally activity. In the homogeneous good, flexible price setting, monetary policy and the exchange rate can affect economic activity via trade channels, even with dollar dominance. In other words, what we conclude here is that changing those two assumptions lead to very different conclusions. And this is hugely important for countries deciding whether and how to conduct macro policy to stabilize their economies. As we recover from COVID, many emerging markets and developing countries, as I said earlier, will be much more constrained in their fiscal capacity, and this will necessitate a bigger role of monetary policy as a counter-cyclical tool. And the results from our papers suggest indeed that monetary policy can help as such tool, and it should be used. Thank you very much for your attention. I will pause here for questions.
Thank you very much, Silvana, for your excellent presentation, and thank you for being time. Now we have more time for questions and answers. Our first question is from Ben, and Ben sent this question somewhere during the slide 12 or 14. I'm not quite sure if it helps you. So he asks, hi Silvana, In your opinion, should inflation prove not to be transitory? Do you believe a hike of 0.15% would suffice, or do you believe more would need to be done?
Is that the question about the model or about what's going on today with the data? So
Can Ben send?
Perhaps Ben can clarify if he's thinking of an exogenous shock in commodity prices. Is that what he has in mind? So the exercise, just to clarify the exercise we're doing here, we're trying to see how monetary policy transmits to the real economy. What happens when the central bank lowers or increases the policy rate? That has an effect on exchange rates and through that on export volumes and activity. We're not addressing the other question of what would happen if there is a shock to an exogenous shock to commodity prices, if that's what Ben has in mind. Within this class of model, if you are considering that set of shocks, so an exogenous shock to commodity prices, for example, and if you are a commodity producer, right? Then monetary policy as a stabilizer will try to, if again, and let me highlight, as a net commodity exporter, then the optimal monetary policy there will be to lean against the shock. But the response will depend on what's your position, what type of commodities you are producing and exporting. So it's not a general overall conclusion. If I understood Ben's question concretely, it really depends on what kind of country we're talking about. And I hope one thing that I'm stressing here is that it's very hard to try to apply a model that is good for the US to developing and emerging economies. We need to understand the underlying assumptions, clearly calibrate those economies and to reflect realistically what they are producing and exporting and the flexibility in their prices before drawing any conclusions. But just to clarify, the exercise here is to understand how monetary policy transmits to the real economy. That's the exercise.
Thank you. Then Yrjö J from Finland. First, he wants to congratulate you on your award. So he asks, in your opinion, will the introduction of central bank digital currencies have an effect on the dominant role of US dollars?
Well, that's a very interesting question. It's not necessarily related to my talk today. The question is, again, how this pans out, how quickly central banks enter into the digital domain. There might be some first mover advantages. So central banks that entered those markets earlier gain more dominance. So, but I think, it's too early for me to judge. I can see different equilibrium, which, some dominant currencies dominate, but at the same time, having digital currencies might ease the conversion into different countries and into different currencies and might allow equilibrium with many multiple currencies. So I think, again, this entails a whole set of other considerations that are not in my model, and it would be a bit far-fetched for me to try to stretch and speculate about those. So my sense is that it really depends on how and when central banks digital currencies are introduced, and I don't know how that will work out. It's too early to judge.
Okay, and then there's a question from Peter. He asks, following your colleagues' hawkish rhetoric, the market has quickly priced a Bank of Finland rate hike path to over 0.75% in the next year, but does not price bank rate going above 1%. Can bank rate go above 1% this cycle?
Okay, so I'm here to talk about the paper I just presented. Is about my academic work. I'm not here as a Bank of England officer or MPC member, so I'll try to answer questions that are related to what I just presented, and then in another forum we can talk about monetary policy in the UK. Today I wanted to talk about dominant currencies and the implication for monetary policy, which, as I said, is more geared towards developing and emerging economies that tend to produce commodities or commodity-like goods and services in settings of a high degree of competition and flexible prices. We can talk about the current juncture in another setting.
Yes, there are actually a couple of related questions. Then there is Adam. He congratulates you on the award as well. Regarding your presentation, how important is the role of dollarization for input prices?
Thanks. Yeah, that's important, and so because you know as I said, the more relevant imported inputs are in the cost base of the producers in emerging or domestic, emerging or developing country. The lesser is the effect of the exchange rate depreciation in the cost, in total cost when expressed in dollars, right? So it is important, and here we are assuming that all imported inputs are priced in dollars, so that mechanism is there. And what we stress is, as long as you have labor inputs or real estate that are set in domestic currencies, as long as they are important in the cost base, you will still have a role for exchange rates as automatic stabilizers, even with those imported inputs in the production basket. So they play a quantitative role, and that's important to calibrate if you want to understand the effect of monetary policy on the economy. And that's what we are trying to do here, to have them in the quantitative exercise. And as you can see, I mean, even though we have them and they're important quantitatively, that still doesn't bar monetary policy to have a big effect on exports and output in these economies. Yeah, definitely important for the quantitative result. If you're talking about a specific economy, you need to calibrate to those particular shares of imported inputs in the production process. Here we are using an average, and then if you want to focus on a particular economy, you can do a better fine-tuning. And thanks, Adam, for the question, and congratulations.
Thank you very much, Silvana. I guess now we can have a break. So we will come back at 2:30. So thank you, Silvana, for your excellent presentation, and congratulations again.
Thank you very much to you. Thanks.
Welcome back to Yrjö Jahnsson Award lecture. Next we have Professor Ricardo Reis from LSC talking about inflation and expectation and public debt. So please welcome Ricardo Reis.
Hi, good morning, or good afternoon, I guess. Thank you very much for having me. It's really a pleasure to be here, even if, of course, the circumstances of our times have implied that I cannot be with you in Helsinki, as I very much wish I could. It was a surprise and a great pleasure to receive this award, and I treasure the possibility or the opportunity of being able to spend an hour with you, sharing with you some thoughts inspired by my economic research. At first, when I thought about what I should use this time for, how I should use this great opportunity, I thought that perhaps I could talk about some very recent research that I had, or alternatively, go through the papers that over the last 20 years have shaped my view of the world through my research and which have motivated the awarding of this honor. At the same time, given that we are here at the Jahnsson Foundation, a foundation devoted to promoting economic research and in the pursuit of the common good, of welfare, of improving our understanding of economics and policies and how to make our societies better, I thought that perhaps I would spend it instead devoted to my study of fiscal policy, targeted transfers, automatic stabilizers, and how business cycles interact with inequality. That was my first thought when I first learned about being awarded this prize, since that was such an important part of what have been the important economic debates and policy options of a few months ago. However, a few weeks ago, as I started preparing this lecture, I realized that if I wanted to honor Yrjö Jahnsson and discuss this way in which economic research has helped make the life of make economic policy and the life of our citizens better, the topic of the day was no longer transfers, automatic stabilizers, inequality, was very much so inflation. I still hesitated a month ago when sending the title for this talk in thinking, well, it is a mix of inflation with public debt, throwing in expectations on there. But as I prepared and then kept on reflecting, it became more evident that inflation has become, in many ways, the key question of October of 2021. As such, and since so much of my research has been precisely on the understanding inflation from different perspectives, what I will spend the next 50 minutes with you, what I'll try to share with you, is try to respond to a challenge that researchers often shy away from because it is a very difficult challenge, but which prizes like this and certainly the actions of the foundation call us to take upon. And that challenge is, how do I think, how does my research, the one that won me this award, change the way in which one would think about the current topic of the day, and that is inflation. And so that's what I will do. This will be a talk in applied research in the sense of applying the lessons from individually my own research to understand the inflation challenges facing Finland, the Eurozone, as well as many of the central banks and advanced economies around the world. As I said, inflation is back. Just this morning, I updated this slide with simply asking in the news, how has inflation been discussed? And I had dozens and dozens of headlines to copy and paste and choose from Reuters linking inflation to the movements in financial markets, to the Financial Times, for whom inflation instead is best illustrated by a shopping market, by a supermarket, and perhaps more curiously, by the Wall Street Journal, for whom the fear of inflation should be best linked with the fear of what's happening to retail cheese prices. Inflation is back in the news, whether for those who care about stock prices, supermarkets, or cheese. Everyone seems to be talking and thinking and worrying about inflation. Well, if one asks, but what is this inflation? And simply looks at any standard dictionary, one will read a conventional definition that inflation is nothing but a generalized increase in the prices of goods and services that consumers buy. So far, so good. That seems fairly unambiguous. And yet, when one goes and measures inflation, and that is very prevalent in discussion of the last 6 months, it turns out that there's a myriad of indicators that you could use to measure a generalized increase in the price of goods and services. And so whenever there's a new release of prices, whether it's in the United States, in the Eurozone, or in the United Kingdom, to give just 3 examples, one has immediately 10 different versions of what the new release data imply for 10 different measures or indicators of what inflation is. One would say indeed that building on this conventional definition, one can easily lie with statistics, as is often told, insofar as see whatever you want to see in terms of the inflation data. 3 recent examples of this just seeing more of what you want to see or one traditional example of this was, of course, the invention of core inflation in the early 1970s that said, let's not look at oil prices and food prices. After 1972 and 73, inflation in the United States was remarkably driven both by an El Nino event as well as by the increase in oil prices in OPEC. And lo and behold, if you took those out, actually the dramatic inflation people were feeling was no longer visible in the data. In the 2010s, as inflation seemed extremely stable at 2%, according to conventional measures, people who felt that inflation was really higher and hurting them started talking about asset price inflation. It was no longer the price of goods and services, but also the prices of assets that people bought, and that would imply much higher inflation. And in the last few months, whether the convention of looking at inflation in terms of the change in the price index relative to 12 months ago was suddenly, or not suddenly, was argued against for saying, no, one should look at 1 month ago, 1 year ago. There's something, the base matters, base effects matter. And again, changing the definitions seem to at least fit some desired stories. All of these are legitimate, and this is still the correct definition of inflation. But economic theory also tells us how one should measure inflation, what each of these different measures actually answers, and they answer different things. And in this lecture, I will use my research over the last 15, 20 years to tell you how to think about inflation, how to think about what these different indicators mean, and how to operationalize the conventional definition. There are 3 different perspectives on price indices in economic theory, the 3 of which are actually quite different because they answer different questions. A first one is to think of inflation, or of the price index, of measuring what is the overall price level in the economy, as being a problem of measuring the cost of living. And that is that given an amount of income or of spending in euros, how much should I have to discount it to get a measure of well-being? Namely, what index of prices must I construct in order to compare if my nominal income increases by, say, 10% in euros, how do I need to adjust that by the fact that prices also went up by 10%? And so even though I am richer in euros, given the higher prices, am I really better off? Has my welfare gone up or down? That is the cost of living problem. A different problem is to understand if I want to, say, index my pensions or my wages such that the revenue that I get today when I fix that pension, when I set my wage, when I set my prices, how do I think about that price, their wage, their pension in the future, a year, 2 years from now? How should I forecast the change in prices such that I'm setting that to be constant in today's units? Okay. On that perspective, since almost all price indices are going to share a common long-run component, inflation, or the perspective on the price index is, well, you can, and this is in many ways a statistical perspective, is that yes, you can make lots of different averages of price in the economies, but what you want to measure is this common long-run component to all of those averages. Neglect transitory movements, focus on where inflation is heading. This is the price index tradition that dates more than a century, and that leads to price index theory being originally a branch of statistics, of index number theory, of mathematics. A third perspective, itself very different, It's that to think about inflation as a change in units. If I go from measuring the price of a banana instead of euros in cents, how do I think about that change how do I measure those changes in units of account? That should, to a first approximation, certainly once people are fully informed, lead to no changes in relative choices and relative prices. Much like when I go from measuring height in centimeters to measuring height in inches or feet, to what extent can we go across those measures to make meaningful comparisons when we're comparing, say, the well-being or the GDP in Finland as opposed to the one in Belgium, or to compare what are those amounts, how to compare euros in Finland in 2021 versus euros in Finland in 2001. Those are given these three dominant ways to think about prices and inflation. I'm going to go over each of them in turn before turning to monetary and fiscal policy and how they affect them. Inflation and the cost of living. The ideal price index has been defined many decades ago, and this is a fundamental result in classical microeconomics. One can think of consumers as minimizing the product of a price vector and a vector of goods that they consume, subject to trying to achieve a well-being, which is nothing but a function of what they consume, the basket consume into utility units, that is at least as large as some benchmark number U bar. This defines what's known as an expenditure function that says that given a certain U bar, how much do I have to spend, and given current prices, and insofar as I choose my consumption basket, to achieve that level of utility. Okay. Now, given that expenditure function, it follows that that expenditure function is equal to the whole of the income that I have, Y, and under some not too restrictive assumptions, we can think about that expenditure function, when the assumption here is of homogeneity of degree 1 of the utility function, is as separating itself as being a linear homogeneous function of whatever the U bar is. Then it follows immediately that U bar, the level of well-being, the benchmark, is equal to my nominal income in euros divided by this expenditure function. Well, facing then the problem of how do I aggregate different goods in an economy? I have apples, bananas, oranges, haircuts, and thinking about, so how can I measure some sense of real GDP, real outcome, real output in this economy? Well, one answer to doing so, to going from a nominal GDP of Finland in 2021 to some real measure, would be to denominate the entire GDP in units of apples or bananas or carrots or something else. But the ideal price index problem following this logic is to say, no, let me measure the GDP of Finland, what we call the real GDP, a quantity measure, by dividing by this expenditure function, because then by dividing the nominal GDP in euros by this particularly theoretical construct, E of P, I will get GDP in units of utility. There's a huge literature that many of you may have encountered that talks about whether real GDP measures welfare. And there's a huge literature saying that this really matters, this question. How do we measure GDP? Is GDP a good measure of welfare? Well, there's a silly answer to that question. Yes, real GDP measures welfare. Why? Because the definition of the price index, the deflator, and that's what E of P is, a function of prices, is such that, under the ideal price index definition, that real GDP is by definition utility. The more productive answer, as opposed to the silly one, so does real GDP measure welfare? The answer has to be yes, if you measure real GDP using the ideal price index, is that flaws in GDP measurement are all ultimately flaws in building price deflators. That measuring inflation matters when we're trying to build a measure of real GDP. This is price index theory as measuring the cost of living, as translating nominal units into real units, where those real units are well-being, utility. The two classic issues in this literature have been substitution bias and new goods. In particular, the substitution bias problem is that if we're to fix the baskets that we use to in which to calculate a price index, the EFP function, okay, this is what a price index is, then you neglect the fact that as the price of some goods goes down, the consumer will switch to buying more of those goods, and in doing so, get higher utility. Most countries now use chain weighting as an approximation to deal with this, but it's important to know, because otherwise, by fixing the basket, you'd be overstating inflation. A second problem, a second classic problem, is that of new goods. When a new good is introduced, it is as if its price went from infinity to some finite value. You can now pay something to get it, whereas before there was nothing that you could have paid to get it at all. How to measure that, since infinity poses all kinds of problems to calculate rates of change? Any finite number divided by infinity is equal to 0. By not taking into account a substitution bias in new goods, we have been overstating inflation. Welfare is higher than we thought because people are able to choose cheaper baskets of goods, and because new goods give them a welfare that is understated when calculated GDP deflators. These are not small numbers, namely, this is from some recent papers on this. The substitution bias that comes and the consideration of new goods, for instance, implies that inflation, even if over the last 10 years on average it was a little above 2%, actual inflation was somewhere between 2.2 and 1.8%, depending on where in the income distribution you look. And in particular, you end up with the inflation rate having been considerably lower for richer households relative to poorer households. Their welfare, their cost of living has actually increased more and their welfare has fallen. Alternatively, in trying to measure the new goods, you end up with the fact that because we are overstating inflation, true growth rates have actually been higher than measured growth rates given all the innovation in our economy in our 20 years. So both of these classic reasons lead you to overstate inflation. These classic issues have been particularly important in the last 12 months. As the consumer baskets of people have changed, both in the United States and the United Kingdom, and they changed quite dramatically in 2020, we ended up overstating inflation quite considerably we ended up understating inflation quite considerably in the midst of 2020 because we ignore the fact that people being locked at home had no longer access to many of the goods that they used to have before. At the same time, more recently in 2021, we have been overstating inflation by neglecting the fact that with the opening of the economy, the consumption baskets have changed quite considerably. And in doing so, people have not actually suffered as much as the high inflation has implied. So these issues, often seen as esoteric issues that researchers would care about but don't matter so substantially, imply actually a quite dramatic adjustment to the wild swings in inflation that we have seen recently. Moreover, there is a harder issue, and one that in my own research I have explored, which is that our measure of inflation suffer from a static bias. This theory was for a consumer that chooses its consumption basket at one period of time, given its income today and the well-being that it will accrue in 2021. But people care not just about utility today, but utility summed over the many periods in which they will be alive. And in that utility function, not only care about the future, they realize that they consume not just non-durable goods like apples, bananas, and carrots, but also cars and houses that are durable goods. And finally, that in order to support those durable goods as well as their future consumption, they are able to save in bonds, equity, and other savings instruments. As a result, the price index is not just the EFP that is here, there will be a static equivalent, but rather is the change in wealth as opposed to just a change in current income that would imply that I can achieve the same utility, the same indirect utility, the same value function as one would have appreciated before. People live for more than one period. Durable goods are important and savings are important. What this implies, this dynamic approach, this trying to deal with the static bias of conventional measures, is first that real interest rates matter. For savers, lower interest rates raise the cost of living because they imply that the cost of the consumption that they're going to have in the future when they retire is now much higher. House prices matter beyond rents because the expected capital gains and losses come with losses and gains in utility and in the ability to afford more or less consumption into the future. Price indices must include real interest rates and must include the variation in durable goods prices beyond just their user cost and their rents in order to take into account the actual effect in well-being in a dynamic perspective. This matters. Over the last 10 and 20 years, real interest rates have fallen quite significantly, especially with regards to trend growth. Inflation has been very steady at 2%. But if you consider this fall in real interest rates, actual inflation in the sense of the increase in the cost of living of people living in the last 10 years has been considerably higher, above 3% in some estimates. Likewise, house prices have increased, and they have particularly increased in the last year. That increase in house prices implies as well that inflation has been understated in the last 6 months, because the effect of the house price on inflation has greatly increased the cost of living in our economies, well above and beyond what we've seen in rents. As a result, a dynamic consideration, such as the one that I have explored in my research, leads you to think that inflation has been understated, both in the last decade and in the last 6 months, even as static classic issues would have tell you to think that it is overstated. Dynamics matters. Measuring of the cost of living is important if we want to assess welfare. Second, inflation and trends in prices. There is a classic tradition that was born in the 1970s of looking at core inflation and justifying it because core inflation forecasts future inflation a little better. However, this forecast superiority is weak and very much out of date. One can do much better than core inflation if one wants to look at a price index that is a good measure of the underlying core. If one wants to stick with simple indicators, median inflation, for instance, would do much better. Core inflation is a concept that has far outlived its purpose, that has little justification to be used nowadays. If one looks at inflation and one wants to predict its common component, there are two important things to note. The first one is that measuring the persistence of inflation, one gets an image of great persistence in its persistent component, pun intended. Meaning, inflation seems to have a permanent component, tau here, that is approximately a random walk. And this is what central banks, if you want, and more generally, if you want to forecast, the forecasting part that you really want to be focusing on. At the same time, inflation also has other movements, here denoted by this eta, that on top of this persistent component add quite a bit of the fluctuations that account for what we see year to year when measuring inflation. Well, what that implies is that as we have seen the zero correlation of inflation falling, and that is the gray line here for the US, for the UK, for the Eurozone less so, but with a smaller sample. What you see in the United States is, just to focus on the United States, although one could say the same thing about the UK, is that even as zero correlation of inflation fell, it is still, this happened because the variance of these permanent components, okay, this parameter theta capturing the variance of how important is the transitory relative to the permanent, increased, and that is the black line here. That is what the conquest of inflation of the 1990s and 2000s was central banks being able to lower the importance of this permanent component such that only the relative price deviations would be left, the temporary deviations would be left. That was the great conquest of the last 20 years. Thinking about it from that perspective, thinking about it as controlling the persistent component is what has become important. But what about, likewise, not just comparing permanent and transitory, but thinking about relative versus absolute prices? An alternative, likewise statistical approach is to decompose inflation into its pure inflation component, the simple change in the unit of account, the equiproportionate increase in all prices, from instead aggregate factors driving relative prices and idiosyncratic factors. In the 1980s and 90s, again, central banks not just conquered the persistent component inflation, they conquered the pure inflation. That is the equiproportionate increase in prices. Since 2000, inflation has been almost entirely driven by changes in relative prices, in absolute relative price across sectors, in trends in the relative price of services versus goods, IT products versus other products, more labor-intensive goods like healthcare and education relative to others. And that has been the case both in the United States and in the Euro data. So, looking at the past, the conquest of inflation was a conquest of the permanent, pure component of inflation. There was no great fall in either the transitory component or in the relative price components in a sectoral sense. It is important to understand that when we speak today about why inflation came down and what really was achieved in the last 20 years and the extent to which it was not luck but good policies. What about the last 12 months? If one does the same decomposition over the last 24 months in this picture, what you see is that the last 12 months are truly highly unusual. And they're unusual because the high inflation in blue here, either the Eurozone or the US, was not driven by pure inflation, was not driven by the sectoral relative price changes that had driven it for the last 20 years. So neither the component of the 1980 to 2000, nor the component of 2020 drove it. Instead, they were really driven by idiosyncratic relative price movements. Okay? That is, it was the last 12 months are indeed highly unusual when looking at our measures of inflation because they're driven by idiosyncratic, industry-specific, as opposed to sector-broad or pure broad movements in inflation. And that has to guide our interpretation of what's going on. Note, though, that whereas in the Eurozone, up until recently at least, there was no movement in pure inflation, in the United States, there is a worrying movement up of pure inflation in the last 6 months, consistent with some loss of the conquest of inflation of 20 years ago. Third perspective, inflation and the unit of account, inflation as the price level, as the dollar, as the euro, as the pound sterling, are the yardstick through which we measure our actions. It is a fundamental result in economic theory that the pound is just a unit of account, and if people start denominating prices in pennies instead of pounds, nothing changes. There is absolutely nothing in supply and demand economics that pins down the price level of inflation, in the same way that nothing really pins down the fact that I can measure my height in meters, centimeters, feet, or inches. Okay. What does pin down the unit of account in our economies then is not classical Marshallian supply-demand economics, but rather one extremely important institutional feature of our economies, and that is the existence of a central bank. At a minimum, what is a central bank? It is a clearinghouse where payments between banks take place using a digital means of payment, often called deposits at the central bank or reserves at the central bank. Okay? These are nothing but liabilities central bank towards bank. They're nothing but entries in a spreadsheet, in a very large spreadsheet at the ECB. However, because we live in a bank economy where we make payments digitally using credit and debit cards, and soon perhaps even central bank digital currency, what that implies is that it is the value, the numbers in that spreadsheet that end up denominating all the payments and all the savings and all the accounts that we have in banks and then saved in our economy. Reserves, this magical one Excel or one spreadsheet at the Bank of England, ECB, or at the Federal Reserve, defines the unit of account. The price of a good is nothing but how many units of reserves must be exchanged to obtain the good. And because the central bank controls the amount of those reserves, as well as the interest it pays on them, that gives it an extraordinary power to control changes in that unit of account and therefore inflation in that unit of account. Talking about inflation in unit of account is talking about central banks because it is talking about the value, the real value of these reserves, these entries, these spreadsheet entries that are vital, that are central to a modern payment system. Well, let's then talk about, we therefore must talk about what affects the value of those reserves, what affects the credibility, if you want, of the central bank. And let me jump right away to indeed the last, oh, this is a typo, I'm sorry, this should be 2020-21. To what, thinking about the central bank and the value of its reserves leads to implied over the last 18 months. Every theory in economics, the behavior of inflation in the last 6 to 9 months is a great validation of monetary economics. Why? Because every monetary theory that I know of, or at least that we teach to our students, predicted that inflation would rise in the last 10 months. Lo and behold, inflation rose in the last 10 months. Back when in February and March, I gave a speech at the NBR macro annual meetings where I said this: I am willing to bet that inflation is going to increase quite significantly in the last 8-10 months. In the same panel, other speakers said the same, and more notably, Larry Summers has written about it quite extensively in the press. At the time, many people said, some people said, especially in the press or in social media, that this was wrong. Economics was about to fail us again. Economics did not fail us. The last 6 months, we saw exactly what economic theory would have predicted. Why? Why does every theory say that inflation is going to rise? Well, in short, we have, if you want, and I'm here being generous, 6 theories of inflation. All of which, by the way, are not contradictory, but are different pieces that come together in the edifice of monetary economics. The Fiscal approach says that to look at inflation, look at what's happening to accelerations and changes in real activity. Well, during this year, the recovery of the economy meant that the gaps, any output gaps, employment gaps, would be closing fast, therefore pushing inflation up. Instead, Taylor rule, interest rate, Wicksellian theory says, look at the state of the interest rate, not just a short-term interest rate, but potentially the whole yield curve, to see whether monetary policy is loose or tight relative to a benchmark, such as, for instance, the one given by the Taylor rule. If we plug in numbers into any Taylor rule, you realize that monetary policy today is extremely loose insofar as interest rates being relatively low. Thus, inflation should rise, and inflation has risen. Monetarism instead says look at the amount of monetary aggregates, either measured by the size of the central bank's balance sheet, and especially by the size of the banking sector's balance sheet. Well, in the last 12 months, we had record high deposits in banks relative to GDP, and the movement of people of trying to use their checking accounts, their dollars, their pounds, their euros, to chase goods, precisely what monetarist theory says will lead to inflation. If instead you're a fiscalist, you look at the record high public debt and public deficits, as well as the fear that central banks will become subordinate to sustaining those debt markets, especially since they had to come and support those debt markets not that long ago, and you worry that fiscalism will lead to inflation. Perhaps instead you think that inflation is really just the result of a game between the central bank, the fiscal authorities, and the public in terms of the commitment and discretion it has to its targets. Well, the revision of central bank mandates, certainly at ECB and in the US, has led to, and ambiguously, a move towards being slightly more dovish. Maybe too much more dovish or not, that would be a controversial claim which I won't make, but slightly more dovish. Well, more dovish should come higher inflation. And finally, if you think that the last 6 months, and again, this was predicted already 10 months ago, we're going to have some supply bottlenecks, well, these are exactly the cost push shocks that, again, in theories of optimal choices of inflation by the central bank will trade off some higher inflation for speedier recovery. So every single approach of inflation says we should have had higher inflation. We had higher inflation. Okay? The data confirms it completely, whether one looks at the euro area or the United States. Okay? But what about 2021-22? What about the next 12 months? I claimed victory over the last 10 months, but I was on the record saying it in February, so I'm not claiming victory after the fact. What about the next 12 and 24 months? Where is inflation heading? Well, let's ask people and the markets where they think it is heading. If you ask professionals, meaning traders, survey professional forecasters here in the United States, they don't seem to show much. But if you look historically at most changes in inflation regimes in the United States, in the UK, in the euro area, and even in many emerging market economies for which we have surveyed a professional, the one thing you really learn very quickly is how professionals never get it. Perhaps because they have a big pressure to conform, not to stand out when answering surveys, perhaps because they are too close to the policymakers who tell them not to worry and to trust them. But either way, professionals missed the disinflation in the 1980s in the US, they missed the high inflation of the 70s in the US, they missed reversals of inflation in Brazil, South Africa, Argentina, pretty much everywhere. Professionals are not, the green line is not what you should look at. Households in the United States have jumped up, but this may perhaps be driven by biases in their expectations because of, as we saw, the big changes in relative prices, and especially in the idiosyncratic component that may bias the behavior. Markets may be a good way to look at, though. That is, asset prices, not professionals trying to please the central bank or trying to show that they are not out of line with whatever is the social pressure at the time. Actual people putting their money on the line may be a good way to measure where at least the wisdom of the market is pointing. From that perspective, expected inflation in markets has increased by somewhere between 0.7 and 1.5% in the United States for this picture. Of course, some will say, well, it's just at 2%. Well, yes, but it used to be well below 2% before. And so it is the change that you want precisely because there's a gap between this yellow line and a subjective expectation that's driven by a risk premium. Okay? But is this really the question? And here's just another version, but now using only the more recent data of, again, an expected inflation measure according to markets. Well, there's a sense in which looking at these long horizons, while is in some ways the right question to ask, it doesn't really in some ways answer what we would like to answer. And why? Because behind this movement is the average market price. What inflation options reveal is that there's been a quite significant change in the distribution of inflation risk. That is, yes, there's been only an increase of 0.7% from blue to red from 2020 to 2021, but much more important, or let's say more worrying, is the fact that the probability that inflation is going to be very high, that has increased quite significantly. So I think what I would like to answer is instead, what is the likelihood of an inflation disaster? Let me define that. What is the likelihood that inflation is going to be above 4% on average per year for 5 years between 2026 and 2031? Okay. That would be an inflation disaster, and I want that tail probability. The measure here, the average, may be understating or at least not revealing the risks that are out there. Note that more than 4% would be a 10 log point deviation from target cumulative over 5 years. Whether you want to call that a disaster or not, I don't know, but it would certainly be a gross violation of even a generous interpretation of a flexible inflation target. Well, measuring that is not easy, but in my research, I have come up with ways to do so. You can measure probabilities from options, what I called N here, but you need to make 3 adjustments to them. The first one is that those probabilities have to be mapped into not just abstract probability measures, but into objective probabilities of events that happen in the world. That is what this adjustment does. A second one is that you need to adjust from a 5 and a 10-year option to get a 5-year. And that is a very important adjustment. And why is that? Because inflation tends to be sluggish. If people believe that inflation is about to lose itself and go to a 4% as opposed to a 2% average, then insofar as I think that process will be gradual, the first 3 to 5 years would be understating the change, whether you look at the 5 or the 10-year expectations. Indeed, the fact that 10-year expectations are always above 5-year expectations in the data, in terms of those tail probabilities, tells you indeed that this is an important adjustment. And thirdly, you have to move from risk neutral to actual probabilities in the sense of dealing with risk adjustments. So I have done that with 2 of my colleagues, Jan Hilscher and Lauren Revive, and let me tell you what those numbers look like. The first interesting, important result is when one looks at the left tail risk, deflation. Deflation raises real payoffs, and in doing so means low inflation or deflation is not such a bad deal, thus lowering the estimated probabilities. Moreover, because deflation builds up, this also lowers the probability going from the 5-year to the 5-5 adjustment. And thirdly, because deflation comes with recessions, that also lowers the actual probability relative to the one you'd measure from the options. Combine them all, what the last few months reveal is that, and certainly is that the ECB has eliminated the fear of deflation, and even that fear of deflation, if anything, was only high around 2014-15. It has actually been much lower than previous estimates had suggested. Deflation, the fear of deflation has been conquered, had already been conquered the years before, and the last 6 months confirmed that conquest. But what if one looks at the right tail? And let me show you here the US results. In the right tail, what you see is that over the last 12 months, this picture ends in March. I've already done the estimates also for June. It's now, as of September, is 13%. The probability of a high inflation disaster is very large. It has gone from essentially negligible to now something like 30%. Now, let's interpret 13% carefully. Is that large? Is that small? Well, on the one hand, the most likely outcome is still one in which inflation has not gone out of hand. But on the other hand, there's a 10% probability that will happen, a 13% probability, that will happen. And that has increased significantly over the last 12 months. Is inflation going out of hand in the next 12 months, in the next 10 years? Likely not. But that risk that did not used to exist is now very present in the data. Why is that? Or better even, what has monetary policy done about it? One way to assess the extent, well, one way in which the indeterminacy that I discussed earlier and the fact that inflation is, from this perspective, about the value of reserve central bank is that inflation is very strongly determined by the credibility of the central bank, by people's expectations that the central bank will deliver a stable unit of account. Therefore, a measure of expected inflation, people's expected inflation, as opposed to the market tails I was showing you, is a measure of the credibility of the central bank. As importantly as the measure of where inflation is going, it is a measure of whether the central bank has convinced price setters in the economy to trust it that it will deliver its 2% target. To see how important that is, one needs only to remember the high inflation in the 1970s, here with the focus on the United States. Okay? The loss of the inflation anchor, as sometimes it's called, was very much, and even the policymakers at the time understood it, was a result of losing what was at the time called very vaguely inflationary psychology, the psychological environment, which today I would call the loss of credibility of the Federal Reserve in delivering stable inflation. Well, if you looked at the households then, and you look at expectations at the beliefs of the households, they would reveal precisely that inflationary psychology. Whereas policymakers at the time talk about psychology but have no measurement of this credibility, the measure of that credibility, using new data recently, I was able to unearth some new data that allows us to measure that. And what you saw was that indeed between 1967 and 1970, what you saw was that loss of credibility in the left tail of the expectations of surveys hollowing, the right tail fattening, and then a shift of the median as well to the right in a very decisive way in a second period. If one looks across countries likewise and looks at periods in which inflation credibility was lost, whether it's Brazil in 2011, Turkey in 2018, one sees likewise that this indicator of the credibility of the central bank always seemed to signal in similar patterns when that was lost, with a shift first in the right tail, and then so an increase, if you want, a movement in the skewness and variance distribution, or skewness first, variance after, and finally median. And that was very clear in Turkey recently, or in Brazil a little earlier. Let me skip that. So what does it look like today? This picture to me raises alarm bells. If one looks at the United States and looks at where we were before COVID, at the height of COVID and today, one sees precisely the pattern that one saw in the late 60s. A fattening of the right tail, a gradual and slower movement of the median, that is, that skewness and variance are showing a loss of credibility of loss of credibility in the inflation target. The parallels with the 1960s are worrying. And they're worrying not just because those two pictures are so similar, but also because one sees the referring to expected inflation as some exogenous driver animal spirits, transitory noise, that is the use of bad theory to justify ignoring expectations data. Very noticeably, this was clear in a controversial working paper coming out of the Federal Reserve, just bad theory leading to repetition of the mistakes of the 70s. At the disregarding of surveys, a disregarding of the data due to bad measurement, and then potentially with bad luck, as we've had with the movements in oil and electricity, especially electricity prices in the euro area, compounding bad theory and bad measurement. As importantly is a lesson that comes not just from the 1960s and 70s, but from the history of central banking, which was so nicely captured in the title of this paper by Christina and David Romer. Inflation is a monetary phenomenon. There are headwinds, there are tailwinds, but a control over the amount of reserves and the interest of reserves gives an overwhelming power to the central bank. Central banks have enjoyed, for the last 20 years, a capital of inattention. People trusted them, did not pay attention to monetary policy, did not pay attention to inflation. Inflation being so strong in the news now in a way that it hasn't been in such a long time is a sign of that capital being eroded, being used. The challenges of the last 6 months have been that many, far too many, surprisingly too many, worryingly too many, have been hiding, have been failing to acknowledge that inflation has gone up. Far too many, worryingly too many, challengingly too many, have been failing to acknowledge the uptick in inflation expectations, and as a result, they have failed to pivot from fighting the battle of ensuring a speedy recovery to the new battle of keeping inflation and credibility under control. The main concern is that if the central banks lose credibility at this juncture, they will be unable to keep on supporting the recovery with the loose monetary policy that they're pursuing now, and which is in many ways adequate. And the especially main concern is that if one sees some central banks repeatedly refusing to see the uptick in inflation by changing definitions in every speech, refusing to see the drift upwards in expectations by again changing indicators from speech to speech and repeatedly saying that there's nothing to see when there's something clear in the data, that they will leave it too late. They will have sharp monetary policy contraction towards the end of 2022, and we'll have a 2023 recession that may not be enough. Why do I say this? Why do I paint the scenario? Because that was precisely what happened in 1969 when we had a sharp recession in the United States as a result of policymakers appealing to psychology, failing to want to look at the expectations data, failing to want to acknowledge that inflation was going a little out of hand. Finally, on fiscal policy and inflation. A temptation that one already sees in debates when one confronts the high public debt is to say, why not inflate it away? And that comes from a misconception of the history of inflation and of the payment of the debt. It is not the case that inflation has been very used to pay down debts. Quite on the contrary, even if you were to try to think about inflating away the debt today, in work that I've done in the past, I have shown that your ability to inflate any significant percentage of GDP is actually very low. Inflating the debt will result in 3, 4, maybe 5% of GDP of the debt being inflated. And the reason is that the maturity of the public debt distribution is short, and QE has made it much shorter in the last 6 months, as well as certainly in the last 10 years. When you have very short maturity public debt, and you have an inflation process that has some inherent sluggishness, attempting to inflate the debt does not work, because by the time the inflation comes, it has already been priced in, the existing bonds have matured, and new bonds have sold for a much higher price, therefore leading to no benefits. So inflating the debt is a chimera that rarely is actually been achieved, and actually history shows that when inflating the debt happened, it actually was financial repression, forcing banks to hold fast depreciating nominal assets that led to it. Secondly, what about R less than G? Won't that pay off the debt? Well, indisputably R is less than G, but note that that was always been the case in US history and even was the case in many countries. The question was whether rare spikes sometimes happen and meant that most countries are not in the US's comfortable position of usually having R less than G. What's new with RLS&G is that if one thinks of debt, if one thinks of the budget constraint of the government, saying that debt is equal to the present value of primary surplus, but, as I have shown in recent research, also what I call the debt revenue term, and that is that not only you can pay debt with present value surpluses, but insofar as the interest rate you pay on that debt is less than the return on alternative investment in the economy, the marginal part of capital, then the central bank is, the government is earning a debt revenue term, a present value of a debt revenue that arises from the fact that agents are willing to lend to the government at a much lower rate than they could earn in alternative investments. Well, from that perspective, and think of this debt revenue term as now being a very important part of how we sustain our high public debts, then you have to ask yourself what makes government debt special in offering this low return. For that will tell you how large this revenue term is and what will happen to it. And importantly, in answering that question, you come with the fact that government debt provides some safety, some liquidity to the economy. But what does that safety and liquidity depend on? It depends on, one, people never being afraid of inflation. Fears of inflation are the worst enemy of a treasury relying on RLS&G, relying on the debt revenue term. Because once investors start expecting inflation, they will charge an inflation premium. This M minus R gap will fall, and as a result, this debt revenue term will fall decisively. Okay? Inflation will affect precisely the high inflation or expectation of high inflation, risk of high inflation is not a benefit of inflating away the debt. Quite on the contrary, it is the would be the beginning of the end of the sustainability of the large that we have. Likewise, this term is driven by the fact that it will be liquid in a crisis. But for that, we have to make sure we have long maturity. Yet, the fact that we had such large QE and such large shortening of debt issuances by the governments means that now debt is being de facto rolled over very frequently, thus making the investment in that debt less safe. Likewise, will it be a safe haven in crisis depends on whether you have the primary surplus elasticities. But again, here, a period of high inflation would be, as usual, if anything, is usually associated with lack of fiscal space elasticity and would therefore be less likely. Fourth, if the debt revenue term is driven by foreigners wanting it, then note that this relies on the stability of the dollar or the pound of the euro, and again, inflation would be a big hamper to it. In short, and to conclude, I think, yes, I'm 3 minutes from my time, or am I 2 minutes over? Anyway, either way, let me conclude. I try to use much of my research as well as others' research to look at October 2021 and interpret what's been going on with inflation in the last 12 months and what will happen to inflation in the next 12 to 120 months. I made 5 points. If one measures the cost of living, then classic considerations say that a dominated concerns literature in the last decade say we've been overstating inflation. Yet I argue that dynamic considerations say that we've been understating it. And as a result, measurement of the cost of living needs a big update. Second, that mostly we have had in the last 12 months, or that the history of inflation is one of conquering the pure permanent component, such that inflation in the last 10 to 20 years has been dominated by aggregate relative price movements. And that, as I would say, probably been a very good last 10 and 20 years of inflation outcome. The last 6 to 12 months, though, show that it is not the aggregate relative sectoral component, but rather idiosyncratic relatives that are moving around, and that, so it's mostly relative, and so far apparently short-lived, although with a big question mark of the last few months. Third, when one looks at the unit of account, there is now a clear sign of significant upside risk being priced in financial markets, that it is not that inflation is expected to go out of hand, but there is now a clear risk that it will do so. Fourth, that households have started in the United States in a big way, much less so in the euro area, almost not at all in the UK, have started doubting central banks. Central banks are facing a turning point, and I worry that they will make the mistakes in the past by neglecting what the data is saying, by underestimating their power to control inflation, by overreacting too late in causing recessions. And finally, fourthly, that inflating the debt is a chimera. It is not the right option. And quite on the contrary, the fact that we've relied on R less than G gives a strong argument to keep credibility of inflation, to avoid the subside risk, to react strong to the turning point in order to keep public finances stable, well anchored, and the debt sustainable. In short, that I think relative to what one could do some years ago, and certainly relative to what one hears in discussions sometimes in the public, that economic research has led us to have very different perspectives of inflation than the ones you will find, and all of them came, I think, into light in a very interesting way, if nothing else, over the last 12 months, and I think we'll do so as well over the next 12 months. Thank you very much, and I'll stop here and open for questions.
Thank you very much, Ricardo, for your
Ricardo,
excellent presentation. And now there is time for a couple of questions. First, there is Adam Kulan who asks, the lift-off in inflation this year may be seen as a success of all available inflation theories. But how can we discriminate between these theories in light of the failure to deliver target inflation over the last decade? Isn't the supply shock the only one remaining on the table? Nyt ei kuulu ääni.
Sorry, I'm not sure I can. Thank you very much for the question. Although, let me try to restate it, perhaps, or let me try to reinterpret it. You claim that there's been a failure to hit the inflation target in the last decade. I'm not sure I quite agree with that. I mean, if you look, well, first of all, I think decade. The key there is what point in time do you mean? Let me say 2 decades. In the last 2 decades, average inflation in the United States, in the euro area, in the UK has been on average pretty close to 2%, 1.8, maybe 2.2. But God, I mean, if we're arguing over 20 basis points, clearly this has been a success, especially since measurement is so hard on this. I think what you mean, so that would be if you look at 2 decades. If you look at 1 decade, the picture doesn't change all that much. I think what you're referring to, and which is quite correct, is that over the last 4 years, 5 years, pre-COVID, the ECB had been undershooting. The Fed had not, the Bank of England had not, the Bank of Canada had not. Inflation had been on average pretty close to 2%. So I'm guessing that what you have in mind is the ECB, the fact that the ECB had been undershooting its 2%. I don't think that was a failure of any theory. I think there's good reason, the same theories that I told you could explain the last 6 months can also quite easily account for the previous 5 years of the ECB. Why? Because partly given its target of inflation 2% and below, the ECB was quite comfortable with inflation being around 1.5. And again, if we're arguing between 1.5 and 1.2, then again, we're arguing over a few basis points that are very far from being a failure of theory. Indeed, the ECB found itself reviewing its mandate, but only recently, to say that it wants inflation to be higher, on average 2%. Therefore, if only now it wants average 2%, and that was significant change, the fact that on average it was below 2% must not have been such a great deviation relative to what was being sought after. So I would say that no, there isn't necessarily a failure earlier. On the last 6 months, as you noted, all these different theories point in the same direction, but as you noted quite correctly, from the perspective of an economic theorist like myself or an economic researcher, the last 6 months are disappointing because they don't allow me to separate between those theories. As I told you, it's a success insofar as the data accord to the prediction of theory. It is a failure, that's, if you want, backward looking. Moving forward, it is a failure, if you want, of not generating data and variability that I would like. But insofar as I care about welfare, not about my life as a researcher being easier through variability, then I will just have to work harder in my econometrics, use the natural experiments that just won the Nobel Prize on Monday to be able to separate between these theories, which the data does not separate so easily in the last 6 months.
Okay, thank you. Additional question related to previous one. Is there anything you would agree with regarding Rod's critique of inflation expectations?
Is there anything I would agree? I agree that a central bank, I agree that a monetary policy that responds to month-to-month movements in inflation expectations will be doing a big mistake, will be increasing volatility of inflation, will be needlessly responding to an indicator that in its month-to-month fluctuations should not be paid that much attention to. So I agree with that one. Two, I agree along very similar lines, or following from the first point, that treating inflation expectations as if there were some exogenous animal spirit, as if there were a shock that the central bank responds to, much like any other exogenous change in the model, would be a wrong usage of inflation expectations and will lead to bad monetary policy. That fundamentally there is no more endogenous object than inflation expectations. Indeed, in my presentation, I discussed inflation expectations as a mirror of the credibility of the central bank, as a mirror of the inflation developments, as a signal of what is to come. To respond to that as if it was some exogenous animal spirit was a mistake done in the 1960s, is a mistake they want to be doing now. So, I agree that one should not be responding to inflation expectations month-to-month volatility as an indicator of monetary policy. I agree that one should not be referring to inflation expectations as something exogenous. Pretty much everything else I disagree in terms of the theory, empirical arguments pointed there, and certainly with the overly stated and wildly claimed views that inflation expectations do not matter.
Thank you for your answer. And then there is a third question. Does it follow from the proposed cost of measure that central bank should start responding to house price inflation?
Not necessarily. And this is why it was important to distinguish between the different measures of inflation. If you want to measure well-being, if you want to measure real GDP to assess progress, economic progress, to assess how much better off we are now relative to 20 years ago, then you need to measure the cost of living. To do that, it is very important to understand what's happening to house prices. But if you're thinking about monetary policy, if you're thinking about inflation as a unit of account, then these movements in house prices may or may not reflect changes in the unit of account. Therefore, they are something that the central bank can do something about or not do something about. Okay? In other words, changes in house prices, insofar as they reflect themselves in part a change in unit of account, should definitely be about the central bank. But insofar as they are a reflection of, as I was talking in another part, aggregate relative price movements, then they are something that central banks may respond to, perhaps, but that ultimately they do not control, which does not mean that they're not relevant for the cost of living. To give perhaps an example to elucidate that, the entry of new goods, the change of varieties of goods that I showed you as well, changes the way in which I measure what inflation has been from the perspective of the cost of living. Would central bank policy, higher or lower interest rates, lead to more new varieties of iPhones or cell phones being introduced? I'm skeptical that it would do in any significant way.
Thank you. Then there is yet another question from Professor Ari Hyytinen from Hanken School of Economics. Congratulations on the award and thanks for the excellent presentation. While you did not directly speak about it, many ordinary households are wondering what to do with their limited savings now that inflation is rising. Since private financial advisors may have biased incentives, the public would appreciate unbiased academic advice. Would you like to share on your own views on this?
I would be very weary of trying to give personal financial advice to people, since these are very important questions, choices that people have to make in terms of their saving, and as a result, they should think about them individually, given their needs, given their expected income and consumption profiles, with great care, since the impacts of that are important, and very importantly, without overreacting to this or other lecture and engaging in speculative behavior that leads them to take on too much risk they'll be unwise. So, very important answer to that question is do not listen to me or someone else telling you absolutely you should buy more of X and sell more of Y when deciding your personal finances between today and tomorrow. Make a solid judgment that does not overreact to those to these two different pieces of information, but that is slower to adjust. So that I think is very important. That's why I want to spend 90% of my answer to your question just stating that very clearly. If anything, we know that households pay too much attention to idiosyncratic news. They trade too much. They change their portfolios too much, and let themselves be infected by speculative discourses that just lead them to lose money relative to, let's say, more eager professionals. Having said that, I think what's important as a public, as opposed to as an investor, is that the public restates the need to keep inflation under control, that while it is welcome that, for instance, the ECB now has a somewhat broader mandate, given its new interpretation of its secondary mandate to include climate, inequality, and other very important concerns, that the public puts pressure over our public policymakers to remind them that ultimately the ECB and the Maastricht Treaty says that its main duty, its primary duty, is to keep inflation under control. And primary means primary. That means that as much as it does a good job in helping with financial stability, with climate, with inequality, if the ECB loses control of inflation, it will have failed, because that is its primary goal. Reminding central bankers that controlling inflation is their main goal and a focus on that is important is, I think, a first order issue. Secondly, that pay attention to the speeches and the central bank policy actions of the next 6 months, because as I indicated, I think we are near a turning point insofar as we will discover in the next few months which central banks are committed to keeping inflation stable and which are not. Observing that, and there's already quite a strong discrepancy between the speeches you see, say, coming out of the Bank of England and the ones coming out, say, of the Federal Reserve, to talk about two parts, in terms of observing how differentially committed some central banks seem to be to their main inflation target or not. And in observing those, I think you'll be able to infer a lot about what the near future will be.
Thank you. Okay.
Thank you for your very interesting presentation and very inspiring. My question is about central bank credibility in the eyes of the markets. You said that central bank credibility is losing in the eyes of households. The inflation expectations have been risen quite a lot, while market expectations have remained rather benign. But as we know, market expectations may change suddenly. And if the market sentiment changes suddenly to the worse, then bond yields, then the market starts to sell all kind of bonds, and the prices go down, and the yields go up, and that could create recession with constant monetary policy, and that might lead to, again, deflationary risk might return for that reason. My second question, which is related to that, central bank credibility is also dependent on central bank independence. Do you see any threats for central bank independence in the future?
On the first question, in a sense, my answer is yes. I mean, I think, Antti, you expressed, perhaps unsurprisingly, in a much more elegant way and summarized the gist of a large part of my presentation, right? Where I showed, look, the markets right now are only focusing on the tail, but as I mentioned in the fifth part of my talk, when I talk about the public debt, how that tail reflects itself, that the inflation rate should reflect itself in the interest rate being less than G, the growth rate of the economy. That tail risk, if it switches, it will be one of these spikes that often happen in countries, even if not in the United States for a long time.
that those spikes, what they show is how inflation risk shows up as a shrinkage of the fiscal space through the net revenue term. So anyway, I guess my answer again is to, perhaps in more confusing ways, repeat what you said much more elegantly, which is to say that an inflation risk, if it materializes, would put enormous pressure on the public finances because it would shrink the net revenue term because of its impact on our RSG, and why I concluded, I think, in my last bullet point or slide by saying extremely important. The commitment to an inflation target is extremely important, I think, right now because of that. On the second question you asked, do I see threats to central bank independence? Oh, I don't know. That is a question that is adequately a political question insofar as understanding to what extent we have both central bankers that are committed to their mandate, and two, that policymakers and politicians will keep on respecting those mandates and keeping focus on inflation. That is really a question of politics in the good sense, not small politics, but big politics sense of what political options our leaders will make. But that ties back to my answer to the first question that I got in this Q&A, which is, I hope the public, who ultimately is those who have a say in a democracy, to transmit and to stay committed to the benefits of low inflation, of how in the last 20 years we've had such an on-target inflation, how beneficial that has been, and how we would like it to continue.
Thank you.
Thank you very much. Unfortunately, the time is running. There are still a couple of questions, but I think we have to end now. Thank you, Ricardo, for your excellent presentation as well, the excellent conversation. And again, congratulations to Professor Ricardo Reis and Professor Silvana Tenreyro for this Yrjö Jahnsson Award 2021. It was our honor that you were able to attend this webinar. And also, we would like to thank both the domestic and the foreign audience for attending this webinar. Thank you very much.